All right, it is 10:36, which was our official start time today. I'd like to welcome you to the February 8th meeting of the Oklahoma City Post-Employment Benefits Trust. The first item of business is approval of the minutes from the December 14th meeting. All in favor? Any opposed? Next item is presentation. Actually, we have the presentation of the it's actually noted here on the agenda as third quarter, but it's the second quarter financials or investment report, right? So it's a second quarter investment report.
So this is
third quarter calendar. Okay.
Fourth quarter
Got it.
calendar.
Fourth quarter calendar, yeah.
Fourth quarter calendar. And if you're June 30 fiscal, it's your second quarter.
Okay. So it's our second quarter report is what we're going to call it because it's our second quarter report for fiscal year. Great. Investment report. The next two items, the next item after that is the investment flash report for December and for January. And so I'll let you take these in whatever order you choose.
Sure. I think we'll start with the large bound
Great.
version. It has the most information. And before going too much further, markets are very difficult right now. Very, very difficult. I know we've been experiencing much of this in our region with oil prices having a depressing effect on the economy. I'm sure revenues are down here as they are in most other municipalities and state government. But now it appears that it's moving into different parts of the economy. Europe is having a tough time right now. There's a lot of uncertainty in the world. So what I want to step back and reflect upon is that we have a very diversified portfolio. We have hedges in place, not like hedge funds, but we have very simple shock absorbers within the portfolio. They were put in place for times like this, and we also have active managers who are taking advantage of the volatility that we're seeing in the marketplace. So this is a point in time that reports are difficult, that you're going to see a lot of negative numbers. Some of our managers might have poor relative results through this period of time, but trust that we're in touch with them very frequently. You know, your equity portfolio, if you look to the markets today, European stock markets, U.S. stock markets, tech stocks, everything else looks like it's going down pretty hard today. But we have the Wasatch Hoisington portfolio, which is up very nicely today, and that's how that portfolio is supposed to act. So going into the fourth quarter market environment, this is when still it seems, going back to December 31, you see on page 2, just taking a quick look at a market environment here. The U.S. equity market, the fourth quarter, S&P 500 was up 7%, and that was a relief rally. You can see the international equity just above that was up 3.2% for ACWI. That's MSCI ACWI. That's all countries in the world, ex the U.S. So that includes emerging markets like China, India, Russia, etc. Now below that is EFA, which is the developed markets. So that's Europe, Japan, etc., up 4.7%. So the big drags that we're seeing on the markets right now are how badly will China slow down affect U.S. companies. We think that it's wildly overblown right now. And that's reflected in the performance differential between ACWI and EFA. If we look down below, for the one-year performance table below that, you'll see that the emerging markets down 15%. This is a pretty large loss for emerging markets, but that's routine. About one out of every 5 years see losses in emerging markets like this. But what this doesn't show is that traditionally recoveries in emerging markets can be 20, 30, 40, 50, or even 60% in the year coming out of these difficult markets. So the S&P 500 was up 1.4%, but as we move lower from there, you'll see that the smaller or more aggressive equities were didn't enjoy positive performance. And you look down to the Russell 2000, which are small caps, down 4.4%. So it was a very narrow market as we got towards the end of the year. Very large companies outside of the energy industry were the only place that were performing well. And this is a type of market that reminds me in some cases of the late 1990s when you saw sort of a concentration of performance amongst very large caps, and the rest of the market was trading away from that. They called that the Nifty 50 companies in the 1950s. where we saw something like this, and then also the same type of phenomenon happened at the end. So that's a good time to have index exposure, which we do. Now, coming out of that is a good time to have active exposure. And another thing that made it very difficult for most of our clients and this portfolio as well is that you had losses in fixed income, right? When equities go down, fixed income is supposed to do well. Now, we have a diversified fixed income exposure, but some of that's more on the aggressive side, higher yielding bonds that are going to yield more than 3% or 2.5% that we're seeing on the 30-year Treasury today. But there is additional risk that has to be endured. Going to the additional parts of the portfolio, or why don't we move into that? The new market environment is extensive in this. There's a lot of data in here, but I want to concentrate more on actual performance. And so if we go to page 10, we still have the big number. It is not green in this case. It is negative 2.7% loss for the full calendar year 2015. So we did have a loss during the year. We look at the page 11 just for a review of the portfolio. The current structure we put together in the first quarter of this year. We removed Delafield, which was a good move at the time. We put in the Vanguard 500 Index, the Vanguard Mid-Cap Index, and Hotchkiss & Wiley at that same time, March 30 of 2015. We also put a new fixed income exposure in. We have a more diversified approach now where we have double line, which is a very macroeconomically risk-averse process. We have Loomis, which is a more aggressive portfolio over the full cycle. And we have Hoisington, which is our interest rate anticipator or our hedging portfolio for everything else. We also have a high-yield portfolio. That is the Lord Abbett portfolio, and it was put into place January 21st of this past year. Just to give you an idea of how much contact we're having with these portfolio managers, I spoke with Stan Major, portfolio manager, Hotchkiss & Wiley, last week. I spoke with Double Line on a conference call a week and a half ago. I had dinner with the lead portfolio manager of Loomis Core 2 weeks ago. I spoke with David Hoisington several times last week. And Lord Abbett High Yield, I had the portfolio manager meeting with him, Steve Rocco, 2.5 weeks ago. So we're very much in tune with what these managers are saying and how they're reacting to the markets right now. I can tell you that Lord Abbett High Yield and Loomis Sales Core are both looking more into the energy part of the marketplace because they think that it's oversold and they're finding good value there. Not in the E&P sector, but in the pipelines and the more stable parts of the market, service providers. So they're finding some value in the carnage that we've experienced there. Causeway did replace Thornburg as our international equity manager. That goes back to 2014. Been in contact with Causeway as well. They're one of the most common investment managers that we have for our clients. In fact, the largest international equity portfolio that we have across our entire total organization is managed by Causeway. And then Dreyfus Appreciation is, again, that unusual portfolio of very large cap stocks that have international exposure. Page 12, you can see where the market value of the total portfolio has gone over time. The growth has been steady. We have had some downturns over time, but we're looking at almost $37 million. I would have reckoned that it's a little bit lower than that today. Our asset allocation is fairly stable as well on page 13, but you'll notice that this does not dive into the underlying managers, which we have become more and more sophisticated over time, where we have offsetting exposures in different types of equities and fixed income. You'll see on page 14, $35.5 million as of September 30, 36.9 or almost $37 million as of December 31. And on page 15, getting an idea of really where the assets are allocated at the sub-portfolio level. You'll notice that most of the colors correspond with the right chart to the left chart, but you will notice that the largest allocation, and that's the Vanguard 500 as of December 30, did eclipse the Dreyfus Appreciation Fund because of superior growth during the quarter. So it now is marginally larger than the Dreyfus Appreciation. Now, in the course of our career, my career, I've often found out that now is the time we need to start thinking about trimming those that have been doing well and reallocating some assets to those that are underperforming, because as much as we study this, there are some fairly immutable laws of markets that they are cyclical. So we're not recommending any change. I know that there's an item on the agenda that we can do that. We're not asking to do that, but I want to make sure that we all understand that that's something. Markets continue to be volatile. We want to be proactive and not reactive and move back to our target allocations if necessary. So moving on the following pages, on page 16, you'll see the asset allocation and performance, that number of the negative 2.767% for the 1 year for the total fund. Yes, it was a difficult rate of return, and we know exactly where those losses came from. Loomis Sayles, before last year, was the top performing fixed income manager for, I think, 5 or 6 years consecutively. They are more aggressive. They are taking more risk in that portfolio, meaning that they are buying bonds that are yielding more than the marketplace, and unfortunately, that hurt them last year. Looking forward, they are out yielding the market by several percent, which for a bond portfolio is a unique opportunity. Now, looking over the last 3 years, 5 years, and since inception, rates of return 5.18, 5.02, and 6.18. And so those are marginally beating the actuarial assumption over all periods. That's the one thing that we pay a lot of attention to, is what is the necessary rate of return? How can we accomplish that without taking extraordinary risk? And we think that that actuarial assumption is achievable. We think clients who have actuarial assumptions of 7.5% and 8% is still achievable given a long enough time frame. Looking at the investments, you'll notice as I go down this chart, there are some funds that don't have returns beyond 1 year or 1 quarter, and that's because they are newer investments. So the S&P 500, remember I mentioned a moment ago, the market is becoming very narrowly focused on the very largest companies out there, and the S&P 500 index fund gives you precisely that exposure. So their 7% rate of return, ranked in the 6th percentile of the large cap value or the large cap core equity universe. So that's doing exactly what it should. And it's not often that you see the index beating that many of its peers. It's a very difficult environment for active managers. But again, that's one of these cycles that we also understand. So we took part of the Dreyfus appreciation portfolio and reinvested it in the S&P 500. So far last year, that was a good decision. Going forward, not certain that's going to be the case, but I think that all of us are probably more comfortable having some active and some passive exposure on the large cap side. Hotchkiss is off to a difficult start, but this is something that we're very used to seeing with them. They do participate on the downside, but if we look over history, their upside performance once markets recover is remarkable. Talking to the portfolio management there, he said 2 years ago he was having difficulty finding things attractively valued. Today they're able to buy companies that are selling for at or less than cash on the balance sheet, meaning that there are companies out there that nobody else pays any attention to, and they have cash in the bank, and the outstanding shares or the outstanding market value of the company is less than cash in the bank. So they're able to find good investments there. Now, that's a similar situation where we have the active manager, which is the Hotchkiss and Wiley, and then the Vanguard mid-cap index, and we like that structure as well. Going down to the small cap side, we're seeing some improvement with Stevens. Remember, they are a very risk-averse small cap manager. However, they invest in long-term growing companies, but not the ones that hit the headlines so often. So if there is an internet bubble bursting right now, if there's a biotech bubble bursting right now, they will avoid a lot of that because they're investing part of their portfolio in what they consider to be long-term growth stories, not quite as high growth factor as some of the most aggressive companies out there, and then some in some misunderstood companies that have interesting products. So that portfolio is starting to do better. Causeway International, they have some emerging markets exposure, limited compared to many. That is almost 10% of the portfolio over the last year, they were slightly below median. We know this firm, we know that they do underperform sometimes when things get difficult. They have some exposure to European financials, which is the big topic du jour. And when I say du jour, it is really what's rocking the markets today, are European financials. But I know that they understand them better than almost any other group that I know in the world. Looking down for our fixed income investments, double line, an interesting selection. Nobody did well during the fourth quarter. Looking back for the last year, they were one of the few that outperformed the benchmark. A very bearish view, meaning that the portfolio manager, Jeffrey Gundlach, does not expect positive economic growth or does not expect the U.S. economy to do as well as most expect this year. So he's very cautious, and you can see that in the exposure. Now, Hoisington, this is an interesting period because they don't look great over this period of time. And remember, they're investing either in 30-year treasuries or 91-day T-bills. And as we ended the year, I believe the 30-year treasury was just over, I'm trying to recall, I think it was almost 3% at the end of the year. Now it's down in the 250s as of today. So without doing anything, that portfolio, if you have an 18 duration, you're down 50 basis points, you're going to be up 9 or 10% since the beginning of the year in this portfolio. It goes the opposite way of the equities. It goes the opposite way of any type of risk in the portfolio. And even when it's not doing that, the returns tend to be pretty well. It is volatile. It is a manager we like to have as a piece of a greater fixed income exposure. Loomis Sales Bond, you can see that their portfolio had a particularly rough year last year, but again, they are a risk, they're not a risk-averse manager. This is a team managed by Dan Fuss, Elaine Stokes, and they have done this, and Matt Egan, and they've executed this process. Dan Fuss has been doing it since the 1960s with very little change. They go out, they find bonds that nobody else likes, and they tend to hold those for a long period of time, and they collect a great deal of income along the way, and that's how they win. So they find risk that other folks are not willing to take. They assume that risk, and they also assume the higher rates of return. So a year like last year when bond market sold off pretty quickly, it's not going to be a great year for them. And then on the last investment we have here is a relatively small allocation to Lord Abbett, high yield, 2.9% of the portfolio. Again, fourth quarter was difficult. Steve Rocco, the manager of this portfolio, if you look at his results versus the high yield master for that 1 year period of time, the high yield master benchmark was down 4.6. He was down less than 2 because he's very risk averse. You know, in some asset classes that are inherently risky, we tend to invest with the lower risk managers. In other asset classes, which tend to be less risky, we tend to invest in some more aggressive managers. And I think that you're seeing right here our low risk approach to high risk asset categories will pay off. And if we had only 2 more weeks of performance here, you would see that the Lord Abbett portfolio did much, much better than its benchmark over that entire period of time. And the inception date here is 4/1. That's the first full calendar quarter that we pin performance back to, even though that they came in a little bit earlier than that. So, yes.
Is there any way we can get performance information for each one of these funds in comparison to the benchmark, even though the inception date, I'm assuming the inception date is when it was added to our portfolio?
Yes.
Is there any way you can provide performance information for these funds relative to the benchmark prior to them being added to our fund?
Absolutely.
Okay.
Absolutely.
I would love to see that information.
Yeah, that's very interesting because when we're looking at some of these, and you think about it, we're looking at good performance when we're considering hiring them, and then when they stumble, which it seems about 50-50 that happens immediately after they're hired, we don't have that good performance record to look back on. And it makes it very uncomfortable sitting in your space, sitting in my place, to look at something like that.
Well, I think it's particularly valuable when we have so many that are new, that you're looking, you look back at inception date and you're used to seeing multiple years, and now you see a few months. So
Right.
I think that's a really good point.
And it's an uncertain environment. When it's uncertain and its times are tough, I know what fills my brain immediately, and it's not positive.
I had one more question, and it may be contained in the information already. I'm curious about how much international exposure each one of these funds may have. I know we have a certain percentage that we've allocated to international investments, but I'm just curious about how many of these funds may have, if not all of them, have international exposure and what the percentage is. Can you get us that information as well?
Yes, I can. I would say that 2 weeks ago, that question came almost exactly the same wording, but replace international with energy. And everybody wants to know what their exposures are.
Is that in a previous report? I wanted to see the sector weightings
Yes.
For each fund. Okay.
I will gather this information, and I will transmit it through Bob, and he can disperse to everyone. So let me see. If we go through the individual fund pages, on page 20, for example, you'll see for the S&P 500 Index Fund, a lot of information about it. Some of this is what you asked for. So Apple Computer, or Apple Inc., is the largest holding, which is the largest company as of December 31, at 3.7%. You can see the largest holdings there. You can also, on the lower left-hand side, see where the portfolio is allocated. Energy, you can see, has gone down tremendously. It's now in the high single digits. And then on the right-hand side, you can see where those exposures are. And I know this is an S&P 500 index fund, so these are companies that are allegedly domiciled and traded within the U.S., but something we've been seeing with so many of these tax inversions. So you're even seeing large companies are changing their headquarters to Ireland, et cetera, but while they're leaving all of their operations here, and that's what you're seeing there. If you go on the following page, you'll notice on page 21, this is the Dreyfus Appreciation Fund. So their portfolio has Europe ex-UK exposure of a little bit less than 20%. But again, many of these, if you look down the list, Philip Morris is still ostensibly headquartered in the U.S., but it's actually a foreign domicile now. Novo Nordisk, Nestle, AbbVie, Altria, are they? I can't recall. But many of these, and these are the largest companies in the world. Something that would be interesting to look at for this specific portfolio is the underlying company's revenue. Where are they actually coming from? Are they coming from U.S. or from foreign? And Coca-Cola does not make a lot of money in the U.S. considering the overall scheme of the business. Same with Philip Morris, same with Chevron, et cetera. So
and if you pull the report on our international exposure, it would be based upon domicile rather than where the revenues are generated.
Right. We have done, it's a pretty big task, but I think we could do it. It'd be interesting for me to know how much of the revenue that comes from overseas. Yes. I would too. I mean, that's going to be very interesting. So, I'll tell you what, why don't we go to Hotchkiss and Wiley on page 23. Now, this is an interesting group. If you look at their process, it's fairly long-term. They're intensely bottom-up fundamental managers. Their portfolio shows that, and they don't really adhere to a benchmark like many managers do. They're looking for value. They're looking for unrecognized value, and they're looking for wherever they have to go to do that. If you look at some of the holdings in their portfolio, say Cobalt or Ophir Energy, these are energy companies that are based in the UK, and nobody really pays any attention to them. And you look at their exposure, they're building some of that UK exposure, and they're a little bit more than 10% there. Now, this is a firm, these are folks we've known for a long time. This is not going to be a repeat of what happened to them in the 2007-2008 period, which is they made a lot of money in home builders, and they held those too long. They are reminded about that experience fairly frequently by me, saying let's not do that again. And I think that they've learned a great deal from that. So their sell discipline is much better now. But if you look at their exposures, they are buying into energy. Will you know here how unpopular energy is? So that's where they're going to be going. They're buying in financials. Most of those financials are insurance companies, misunderstood. Again, we've seen them do this process many times. It can be painful at the beginning as they're establishing positions, but as those positions are realized, I don't know of many better mid-cap managers out there. Now, our Vanguard Index mid-cap fund is on page 24. Yes.
I was noticing that Hotchkiss and Wiley doesn't have hardly any exposure in healthcare. Mm-hmm. Is there a reason?
Well, it's not something that they understand particularly well. It's also an industry that tends to have a lot of consumables that are changing. Now, they will invest in the insurers, but as far as being a company that goes into technology, which healthcare is overwhelmingly technology, short cycles, product cycles there, so I can get back to you. That's my best recollection of why they're not in there. And also, if I remember correctly, technology is one of the better performers through most of the year last year. Or, I'm sorry, healthcare. Then going into our small cap fund, you can see that there is healthcare exposure there, 18%, and this is on page 25. Technology is 24%, but they're investing primarily in internet technology. They're not investing in the Ubers. They're not investing in sort of the next generation of the internet bubble. They're investing in companies that have real products, that have long product cycles, that have what you would call loyal buyers. I like the story that they tell is that if you're a CFO and you're at a company and your CIO, Chief Information Officer, comes to you and says, we need to spend $2 million on internet security, really no matter what kind of company you have, you're going to write the check for that, because the last thing anybody wants is another data breach in this day and age. Then going on to Causeway International, you can see that primarily in Europe, almost or just under half of the assets are in Europe ex-UK. They've got another healthy exposure to the UK, but they've also raised some cash in the portfolio at 5%. So they do have some dry powder. Again, the exposure to the emerging markets, China Telecom, SK Telecom, South Korea, despite having one of the most sophisticated economies that we know of, is still an emerging market. The countries just are not promoted from emerging to developed. And then going into our fixed income exposures here, the double line fund, if we look at that, fixed income is a tough place right now. Do you want to take credit risk? That can ultimately turn on you. Do you want to take interest rate risk, which, at the December 15, when the Federal Reserve raised interest rates, it was with the presumption that the economy was going to be improving. Jury is still out on that one. Some people still think that the Federal Reserve is going to raise short-term interest rates 4 more times this year. Doesn't feel that way. It doesn't feel like it's the environment to do that. I think the last time they did that was during the Great Depression. You don't raise interest rates into a slowing economy, but we'll see how that moves along. These managers that we have are intensely focused on that. Double line is the most, I guess you would say, bearish on an economic recovery amongst our core managers. Wasatch Hoisington, no other manager like them. No other manager like them in the world. They're investing solely in long-term treasuries right now. The yield at the end of the year was 3%. because that's what a 30-year Treasury yielded then. Now we're down into 2.56. So 30-year Treasury yields have come down dramatically, which as a holder, that's very, very good for you. And you'll see their performance fiscal year to date on page 32. They're up 6.5%, while the index was up 1.8. And again, until we have more data points, more time periods that we're looking at, which will provide, Hoisington is, you can see here, they're either top or bottom of their universe, and that's where we expect them to be. Now, Loomis Sales was their own issue. During the year, their yield is 4.7%. They're investing in more credit, more corporate bonds, which was a difficult place to be. They're also investing outside of the U.S., and they're also investing in some non-bond securities as well. So all of those things came together to punish their results during the year. If you look at them for the fiscal year to date and the 1 year, they look absolutely terrible. But they are one of the most proactive investors within the bond market. If we looked at them for the 2 years, 3 years, 4 years, and 5 years, or alternatively on the 2014, 13, 12, et cetera, they would be top of those tables. But since we just put them in place at the beginning of 2015, and we don't yet have the report configured how we would like it to be, you don't see how well they did over those periods of time. And then Lord Abbett, our newest fixed income manager, 7.3% yield on the portfolio at the end of the year. I'm sure it's even better than that today. And Steve Rocco is one of the most interesting one of the most interesting high-yield managers. I've known him ever since he was an analyst, and the way that he looks at the world is get your money back first, or get your client's money back first, and then try to make a return on that, and I think he's done very well. One page as we move forward, again, we still, on page 38 is our status. We're recommending no changes to this. We like to have managers for at least a year before we start making changes here. Yes, Dreyfus is still on alert, and we continue to want them in the portfolio. We like them much better now that they've been halved, and we have the index exposure to take to give us market returns when market returns are good. Now, page 39 is an interesting page. And remember, I told you that we have shock absorbers within the portfolio. This is a correlation matrix. And I apologize, the numbers are small, difficult to read. Color coding helps here quite a bit. So green means that the correlation is positive between these investments. So as we go down the list, you'll see the Vanguard 500 and the Dreyfus Appreciation. Their correlation is 0.97. The scale goes from -1 to +1, so their correlation is fairly high. Now, as we go down to the two bright red rows there, that's Double Line, which is one of our core fixed income portfolios, and Wasatch Hoisington. And as we look at those correlations, negative correlations are fairly unusual in the financial markets, but when we look at Hoisington with a negative 0.81 correlation with one of the other funds, with a negative 0.7 with the index fund, a negative 0.6 with our other large cap manager, you can see just the role that they play. It's tremendous how nicely it is. And one thing that's unusual is looking at the correlation of, say, the Loomis High Yield Fund, which is positive for all of the equities. But then when you get down to their cross correlation, they're also negative with those two core managers, or those two risk-averse managers. So this tells us that we have attractive correlation attributes. Now on page 40, these are the expenses. These are very important in this day and age to pay attention to expenses. You'll see that the average expense ratio is 0.67 on a weighted average basis. If we did that to the category average, it would be 92 basis points. So we are 25 basis points cheaper than it would be if we were investing only in the medians. And also, this does put the index funds into index category as well. So it's an apples-to-apples comparison. Now, as we get down to mid-cap indexes, those get pretty expensive, but on the whole, we're saving $94,000 on management fees per year.
Well, Doug, one of the questions I think I had asked previously is, I do think that this fee information is very good information for us to have. But the other thing I wanted to look at is, in comparison to the category average, the performance. So how are their peers overall, and I can't remember what the response was, but how are we performing, or our managers performing based on the fees that we're paying in comparison to our managers' peers and the fees that they're paying. So when you look at performance, are they generating higher returns for those higher fees? Because it would probably be worth it if we could get higher returns to pay higher fees. So is that information that we can receive, or can it be compiled?
I'm going to have to, so what you're asking are, do the higher fee managers generally outperform?
Yes.
I would say long term, no, they do not. Generally speaking. Now, all the returns that we show in this are net of fees, so that helps some of that answers part of that question. Now, when we're looking through here, the important thing for us is, let's make sure we're not going for low fees just for the sake of low fees.
Right.
Right? And there are some money managers out there who, they look at it as a fee business primarily. We're going to go out and we're going to raise a lot of funds, and we're going to manage it adequately for a while until, the bloom's off the rose. But by that time, we're ready to retire. That's not the type we look at. It's interesting when you look at, say, Hotchkiss, right? 1% seems pretty expensive for institutional asset management, and indeed it is. It's just that there are a lot of other firms out there that charge a lot more than Hotchkiss does.
Well, now I'm glad you brought up Hotchkiss, because that was the manager I was looking at in terms of not having any exposure in the healthcare industry. And when I look at one of the prior pages, looked at how the sectors performed, like their 1 year, healthcare performed very well.
Yes.
And so for Hotchkiss not to have any exposure in that sector is kind of concerning for me, considering that we're paying the fees that we're paying, but we're possibly losing out on some market exposure because they're not invested in that particular sector.
Sure. That's a great, I would not expect Hotchkiss to be allocated to all sectors all the time because they're looking for individual companies. And so when you have a year that healthcare does well, and the prior year healthcare did pretty well, and the year prior to that healthcare did pretty well. So Hotchkiss is not going to invest in some place that's done well 3 years in a row. I mean, that's typically they're looking for, well, after one really bad year, we're going to start looking at a sector. And that's when they start to get interested because they're trying to pay 70 cents for $1 worth of stock. You're not going to typically find that in healthcare, especially today. Now, the one thing that is good is that they're value investors, right? They're mid-cap value investors. We have small cap, and that's very, very consciously investing in growth. So there's a lot more healthcare exposure in that. There's no insurance companies. There's not a lot of energy down there as well. So in some sense, the portfolio design is consciously put there. Right? If we're going to have managers who are active and who don't look a lot like their benchmark, we want them offset elsewhere. Right? So we have up here, we have the gigantic multinationals in the Dreyfus portfolio. There's some health care in there. And then we have the mid-cap portfolio that's very value-oriented. And then we have the small cap, which is also growth-oriented. And then we also have index and index. So there is real rhyme to where they're invested. But that's an excellent point. I mean, when we're looking at Hotchkiss, I'm never going to expect them to be where performance was last year. I think that's part of the lesson that they learned with the home builders. If it's been really good for 3 years, we need to be looking for an exit. Does that answer your question?
And I think it's great that they're looking for value. I think they're looking for companies that they can buy cheaply. When the market is down, I mean, you know, great time to go in and look at those companies. I think that's great. What I think that I'm more interested in is that if they're doing that, if that's the strategy that they're utilizing, is it working? Are they generating returns? Or are they still being outperformed by their peers? That's the concern I have, is that perhaps if that's the strategy they're going to utilize and long-term they utilize that, and we see that we're not getting any value for that, we're not getting any alpha, then maybe we need to start looking at a company with a different strategy.
Sure, sure. And that's the question we ask every day. You know, is this a strategy that has a future? We think it does. And let's, one more data point out there. We have the mid-cap index fund, right? I mean, that's part and parcel of this discussion. Are we getting anything for the active fees that we're paying? And so we sort of blunted that question and said, you know, we're going to have market exposure. And we're going to have Hotchkiss over here doing their thing. So if we have a great year in healthcare and Hotchkiss is not going to be there, then we're going to get the benefit over on this side. And we're not going to pay much for it either. So Hotchkiss, these active managers are always cyclical, and it's always tough. First year, first 2 years, first 3 years before you really see what they do. It's tough. I get it. I have the benefit of having invested with them through some really, really tough times.
I think one of the other things that makes this one really challenging for us to look at right now, looking at these reports, is not having the history.
Absolutely.
That if you were looking at, you know, if you had that history over several years, because there's such a short term in our portfolio, you can sometimes look and go, yeah, they're not doing well right now, possibly, but you look at their history over the past 5 years and 10 years, and you can see how well they perform. So that kind of, I think, adds to some of the question.
Yeah, and that's why I think that having information about their performance compared to their peers, even though they weren't part of our portfolio, would help us a lot, so we can see how their strategy has worked in the past and feel a little bit more comfortable.
Absolutely. Absolutely. Understood.
On the individual valuations that we have, our evaluations of the individual funds, do we have a comparison that's in there, one of the metrics that looks at their performance compared to their peers?
As far as
their percentile rank?
And again, we're still...
I couldn't remember if we had that on this one or if I'm thinking of ERS. There's one of them that I remember seeing that we had a comparison that looked at them. You know, there was a comparison of each of the funds to their peers.
So it's shown in a variety of ways. If I could ask you to turn back to page 16. And what this page shows you is it shows you the returns. It shows versus index, and then the number in parentheses for the very short periods that we have for most of these. It shows you their peer universe rank.
Got it. Okay.
So they are right
here.
here.
We had that. Okay.
Now,
This is the information I'm wanting to see for a longer term.
Absolutely. And one of the things that I really like about this report, I know it doesn't show the data that we want right now, but one of the things that I found very useful is if you go to page 18 and 19. And 18 and 19 shows the same type of information, but it shows it for year over year. Same portfolios, same not availables for all of these that we're talking about today. But if you would look at, say, a Hotchkiss and Wiley, 2014, 13, if you had the real numbers there of what the fund had performed, you would have that.
Yep.
You would be able to look back and say, wow, you know, Loomis Sales was second percentile in 2013 and first percentile in 2012. So let me go shake some. Let me go talk to some people, get this information, get it in the report, find out how we have to footnote it, because I'm sure there's a rule about that. But get that information.
It could even be that it's a separate report that we have to have. So it doesn't, because like you say, this is standard, what you're providing, according to exactly the way we've done it before and all the other reports I've seen. You only report on the activity as long as you've had that fund and been invested with that manager. And so I think I do think we'll go follow your lead on that with whatever the appropriate method of presenting that information is.
Good. Excellent. One of the interesting new pages in this report is on page 41. It shows us where our allocations are. If you look at down at the bottom of the chart there, that shows you the acceptable ranges that we have for all of these. It shows you the target with the dark line, and you notice that we have most of these lines are not right in the middle of the asset categories because we have the ability to pull out of the equity markets and invest more in fixed income. But you'll notice here that everyone is in target, the red triangle for cash of outside policy. That's not really that's an offshoot. It doesn't really matter because remember the cash that we use for operational purposes is held outside of this portfolio. So that is the December 31 second quarter fiscal fourth quarter calendar report, and happy to take more questions about that.
Let's go ahead and take action to receive that report, and then we'll move on to the other two that are just, let's see, that's not true. We don't have to take action on that one. Ignore me. We're ready to go ahead and look at the other reports.
Sure.
Sorry.
I think that if I can get your approval, the December 31 flash report, we've sort of gone way past that with our quarterly report. So if you would go to the December or the January 31 report, January was tough. February has been difficult as well. You look at the returns, the Russell 1000 or large cap U.S. equities was down 5.4%. Small companies down 8.8%. International equities down 7%. China is doing worse than that. Fixed income has done okay, positive returns for the month. I think that there's been a lot of talk about why it feels so bad. But when you stumble coming right out of the gate like this at the beginning of a calendar year, it seems like it's even a more difficult time. We have reached what is called a technical correction. Equity prices have gone down more than 10%. They went down more than 10% in the first half of January, but then they recovered to end up off of their lows. Now today is a little bit of a different story. It's kind of a mess out there, and we need to keep our heads.
It feels so bad because it's not October.
That's true. If it were October or September, we'd be expecting it.
Yeah.
That would be an easy way to go. So as we look down the returns here, the order is slightly different. We look at the total fund was down 4.4% for the month, which is a painful loss. Our Loomis sales portfolio, again, it was down. Double line, positive return. Again, they're more cautious on the outlook for the economy. The Loomis or the Lord Abbett portfolio was down. Hoisington is up 5.6%. Right, they're also up during February, and I would expect that they're going to be the strongest return for the month to date. The index fund is spot on what it's supposed to do. Our active large cap manager outperformed for the month, down 373 versus 496. And a lot of that is because they invest in consumer staples. I mean, it's stuff that you have to buy. So it's your Nestle, your other large, other expenditures that you don't have the ability not to make. Vanguard, the index fund, is down what it is. Hotchkiss, again, they're buying into weakness. That's something that they do. Traditionally, in environments like this, they buy shares in a company, they go down a little bit more, and they buy more. It goes down a little bit more, and they buy even more. You can see our Stevens portfolio didn't go down as badly as its index, and the international equity portfolio the same. So our active managers protected some to the downside. They're not just protecting to the downside right now, but they're also buying attractive companies during this turmoil that we're going through right now. So that's the monthly report.
Are there any questions? So I would take a motion on item 4 to receive the monthly investment flash report for December 31, 2015 and January 31, 2016.
So moved.
All in favor? Any opposed? All right, the next item is, we don't need anything on item 5, as Doug mentioned before. Item 6 is approval of recommendation from the investment committee regarding the trust investment policy, and Doug was just going to kind of give us a quick overview on that, of the highlights of the changes that we're making.
Sure. So if this document is in your packet, it just goes over some of the the changes that we discussed December 14, and then worked with Bob and his staff to make them so. So a lot of these items are cleanup, clarification of items, titles, et cetera. I think that we had this is a good update. If you're going down the bullet points here, you see that the first bullet point is the trust has delegated the ability to vote proxies, and that's somewhat unusual. That doesn't happen very often, given that we're invested mostly in mutual funds, but that's to the general manager. Financial consultant will monitor the trust asset allocation. This is something we've been doing before. This clarifies our duty. We are added responsibility. We've always claimed in that third bullet point that we are fiduciary. We stated it here very clearly. We updated some of the items under the core fixed income. We had a lot of discussion about judgments during our meeting, and this resulted from it. The judgments, the process or the procedure on how those would be evaluated and then perhaps bought into the portfolio was defined. We set a maximum allocation of 10% for judgments. You'll also see that we changed some of the duration guidelines, and then the final bullet point there is minor administrative changes throughout policy. So this was a good process. As fiduciaries, we need to make sure that we stay on top of the investment policy statement, that we look at it like this at least once a year, and then we make sure that we pay attention to it and we adhere to it, because this is the document that is the roadmap.
Are there any questions? I'd take a motion to adopt or approve the changes in the investment policy.
Move it.
All in favor? Any opposed? All right, thank you, Doug.
Thank you, Mr. Chairman.
Next item is acceptance of the financial report for the fiscal year ended June 30th, 2015, and Amy Lucas, who's one of our accounting managers in our accounting services division, is here to present the report.
Thank you, Mr. Chairman, trustees. I'm here to present the audited June 30th, 2015 financials for the Oklahoma City Post-Employment Benefits Trust. The preliminary financials were presented to you guys on September 14th, 2015. Any changes that were made to the financial statements during the audit were not found to be material enough to reissue those statements. So I'm not going to go back and represent those exactly like I did, but I'm going to hit the highlights of what we found through the audit. The final June 30th, 2015 financials you received were audited by BKD CPAs and advisors, along with the City of Oklahoma City's comprehensive annual report. In the auditor's opinion, the financial statements referred to above present fairly, in all material respects, the respective financial position of the trust as of June 30th, 2015 and 2014, and the changes in its financial position for the years then ended in accordance with the accounting principles generally accepted in the United States of America. An unmodified, which is a clean opinion, which is what we hope for, was issued. Within the June 30th, 2015 audited financials, you will also find at the back of what the financials will be that we issue on a quarterly time frame, we've got some supplemental different tables and the actuarial that was put in there that was published by our actuarial. You will find those at the end. There's a schedule of funding progress, a schedule of employer contributions, and notes to the required supplementary information. Along with an audited opinion, the auditors enclosed an independent auditor's report on the internal control over financial reporting and on compliance and other matters based on an audit of the financial statements performed in the accordance with the government auditing standards. The results of these tests disclosed by the auditors that there were no instances of noncompliance or other matters that are required to be reported under the government auditing standards. As published in the audited report for Oklahoma City Post-Employment Benefits Trust, the net position for fiscal year ended June 30th, 2015 was $39 million. This is an increase of $5 million over the fiscal year ended June 30th, 2014, when the net position was just $34 million. The overall financial position did improve during the fiscal year of 2015. These are the highlights that you can find both written in both auditor letters that are within the printed financials. And if you have any questions over the financials themselves, like I said, they did not materially change since they were presented in September. So I'd be happy to answer anything that.
Are there any questions? All right, thank you, Amy.
Thank you.
So I would take a motion to accept the annual financial report. All in favor? Any opposed? All right. Next item is acceptance of the interim financial statements for the 6 months ended December 31st, 2015. And Jake Stiebenaller, who is a municipal accountant 3 in our accounting services division, will present this information.
Thank you, Mr. Chairman. Just going to point out a couple items based off of this December 31st report. First, if you'll go to page 3, looking at the MD&A. Currently, the trust is reporting a net position of $40.33 million. This is an increase of 3.63 over the prior fiscal year when that net position was $36.7 million. The approximate gain of 3.63 is due to an increase, due to decreases of 1.43 in contributions, a decrease of $506,000 for benefits paid. There's a decrease of $45,000 for administrative expenses, and that's offset by an increase in our net investment loss of $371,000. So overall, the financial position so far through the first 6 months has improved over the prior fiscal year.
And so it's improvement
basically
in this first 6 months of where we were in
December
the same period last year,
yes,
right?
Yes, sir.
And so if we look at the change in net position from the beginning of this fiscal year, we'd look back to the $38.9 million at the top of that column.
Yes.
And so, okay.
Yeah,
All
so
right,
we've gained.
So that's just in that 6 month period compared to this 6 month period.
Yes, yeah, we've gained in this 6 months, just not gained as much as we did in the
Got it.
last fiscal
Okay,
year, in the
I got
last
it.
same period time frame.
Great.
The other item we want to go through and point out is on the notes section. So if you go back to starting on page 9. At the bottom of this page, when we go through and look at some of our money markets used to pay our claims, and these are reporting at $4.32 million. Last year it was compared to $9.03 million. So if you look at the bottom of page, or I'm sorry, that's at the bottom of page 9. The top of page 10 shows the same information for the prior fiscal year. And the other point that we'd like to go through and point out, our fixed income securities are reporting at 26.7, leaving the remaining equities at 73.3, which is inside of our recommended guidelines. So, do you have any questions over the financials at this time?
Are there any questions on the interim financial statement through December 31st, 2015? All right. Take a motion to receive the report, or to accept the report, I'm sorry. All in favor? Any opposed? All right, thank you.
Thank you.
Next item is the designation of Matt Boggs, Assistant Treasurer, as a designee as it pertains to the duties of the Oklahoma City Post-Employment Benefits Trust. Did you have any comments on that, Bob? Or?
Yes, this was a item that we thought would be a good practice to send through. As you're aware, I have certain responsibilities as treasurer of the trust, which pretty much fall in line with what I do for the city. However, I also have wear a second hat for the trust as the general manager. There are a lot of things that go on with the general manager portion, things related to the agenda process itself and approvals, also with contract negotiations, with monitoring contracts, that sort of thing, which I felt, any event that I'm not available to perform these type of responsibilities, that I have somebody that could officially back me up. And so we talked with our legal counsel, Dick and Wiley, and they felt it was a worthwhile item to present to the trust. And the city manager has recommended, or I guess designated, Matt Boggs as my assistant treasurer to also serve as my backup for general manager.
All right, are there any questions?
Bob, does Matt have the same level of bonding that you do?
He does.
Okay.
All right, take a motion to receive the designation.
Second.
All in favor? Any opposed? All right. Next item is ratifying claims listing. Could I get a motion?
Move approval.
All in favor? All right. Are there any other reports or comments from staff or from the board members? Great. Hearing none. Yes, I'm sorry. Bob?
I just want to make one quick comment on the investment policy updates. One of the things that we had discussed at the investment committee meeting was possible conflict of interest information within a piece where we were setting up the ability for the trust to purchase judgments. Doug and I had discussed what we felt might be best way to present that. And what I proposed was that we include just some language within the investment policy itself that basically says that my direction on how and when, what judgments are purchased will be based on a resolution and procedures that are established by the trust. I figured that pretty much left it pretty open to where after the fact we could come in as the trustees and by resolution say this is the structure that we're going to set up for purchasing judgments. So I felt that would give the trust as much flexibility, but then still leave you that capability to, dictate pretty much how we manage that judgment process.
So it would just set a structure, though, similar to what we do with our allocation with other managers or in other asset classes?
It would be more or less be an administrative type of a structure that would
But it
tell
wouldn't
me
limit your
how you want it.
flexibility where the opportunities are there
Right.
to be able to act upon that.
Right.
So we
And
would
if there
give
are
you
certain type of judgments that we don't want to purchase and that sort of thing, you could tell me what to do in regard to that resolution. Yes.
Okay. So we'll be bringing that back at a later time then?
Yes, we will.
Okay, great. All right, thank you. All right, then we are adjourned.